stock prices. And as you see here, in particular, stock price of NVIDIA. When NVIDIA did a 10-for-1 stock split, for those of you, I'm sure most of you know that. So they split their stock by 10. So what that means is if the stock price was $100, it's now $10. But if you had one share, now you have 10 times as many shares, or 10 shares for every one share. So net effect is actually zero, right? Your value of your NVIDIA holding in your portfolio remains the same. You own more shares, but at 1/10 the price. And it kind of got me thinking, because I received a lot of calls at that time from individuals saying, hey, NVIDIA is doing a stock split. Should we buy? And I was curious as to why people wanted to buy the stock just because it was splitting. Maybe it was because people feel as though now at roughly $120 a share that the stock was cheaper. Maybe they think that owning more shares is a better thing. I'm going to tell you right now that that's not the case. Owning more shares is not better. Owning a stock when a price, or buying a stock when a price is less, from, in this case, $1,200 a share to $120 a share, it doesn't really help any. It doesn't make a difference. What does make a difference, and how individual investors should look at an individual investment idea, is to evaluate that stock. So you could have a stock trading at $1,200 a share and be cheaper and better value than a stock that's trading at $165 a share. For example, NVIDIA, when it was at $1,200, was trading at roughly 42 times forward earnings, whereas AMD, a competitor to NVIDIA, another US chip maker, large chip maker, was trading at about $165 a share, but trading at about 48 times forward earnings. So NVIDIA actually at that time was cheaper than AMD, cheaper than Micron, another chip maker, cheaper than many other chip makers. So price of a stock isn't as important as valuating that stock, figuring out how much that stock, that company earns, comparing its earnings to its price and to its growth rate. And I think, to me, that is far more important than the price of a stock. One should not look at a stock trading at $100 as more expensive than a stock trading at maybe just $10 or $15, because it's all about how many shares are outstanding, how much that stock is earning, what the price is. That's why you tend to see at times when a company announces a share buyback or a stock buyback, where the actual company is buying back its own stock, that is actually a good thing, because it's removing shares off the market. And that is a good thing for the share price. Our chart here that I wanted to show on NVIDIA, 25-year history of stock splits. And we're going to get into stock splits in our next segment. But I really wanted to show you how much the price of NVIDIA has changed, right? With all the different share or stock splits. You've seen the latest one, 10-for-1, and you've seen to the far right-hand side how much the price has come down. So when you're looking at whether a stock is cheap, whether you should be buying it, look at its valuation, evaluate that company, do your homework. If you're not able to do it, call your investment advisor, call an investment advisor, send me a message asking me if I think a particular investment idea is cheap and good value. That's what we want to look at. We don't want to look at necessarily whether a stock is just a higher price versus a stock at a lower price. To me, that doesn't matter. It's all about valuating that company and its shares going forward.